Expectations the Fed will cut next month have risen on a weak private jobs report. The RBA's minutes are more hawkish than expected, and Australian consumer confidence is boosted by sales events. That's coming up in our 5 Things in 5 Minutes on Wednesday, November the 19th. And then in our deep dive interview, ANZ Commodities strategist Soni Kumari looks at China's ambitions to establish a global gold trading hub to compete with the likes of New York and London.
The path to China becoming one of the important global trading hub for gold, I think it's going to be a gradual process and needs some, real reforms.
But first, in 5 and 5 with ANZ, Fed rate cut pricing for December lifted slightly overnight, but remained below 50%. That came as the ADP weekly payroll series showed the US economy was losing, on average, 2,500 jobs per week in the 4 weeks to the 1st of November. Here's ANZ economist in London, Henry Russell.
That was a smaller rate of decline than was reported in the previous week, but nonetheless points to a softening US labour market and reinforces our view that the risks to the Federal Reserve's dual mandate sit on the employment side and mean that it is appropriate for the Fed to reduce its policy rate at the December meeting. We remain of the view the Fed will cut 25 basis points in December.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was down 0.7% and the Nasdaq was down 1.1% on ongoing concerns about AI valuations. The yield on the US 10-year Treasury was down 1 basis point at 4.121%. West Texas oil futures up 0.1% at $59.90 US a barrel. Gold fell 0.3% to $4,063 US an ounce. The US dollar index rose 0.1%. The Aussie dollar was up 0.1% at 65.02 US cents. And the Kiwi was flat at 56.59 US cents. Number 2. That data comes ahead of the delayed Bureau for Labour Statistics September jobs report this Thursday. ANZ senior economist Tom Kenny says expectations are the jobless rate stayed at 4.3% in September. He says the number may be stale, but it is important, given October's report won't be released in full.
They'll potentially just be using the establishment survey, which is the payrolls data, but they won't be using the household survey, which is where the unemployment rate comes from. Estimates from just the shutdown is that potentially that would add around 0.4 percentage points to the unemployment rate. So you could see it going up to 4.7 if it was 4.3 in September. But that would just be temporary. But there are those that did take redundancies at the start of the year, and that would be interesting to see what they were. So not a complete picture of the labour market there.
Number 3. The Reserve Bank of Australia yesterday released the meeting minutes of its 4th of November decision to leave the cash rate on hold. ANZ senior economist Adelaide Timbrell says they were more hawkish than the post-meeting statement, but not so much as to change the rates outlook.
On keeping the cash rate at the current level, the board highlighted downside risks to its previous assumptions around supply capacity in the economy, as well as upside risks to the recovery in demand. On the potential need to cut the cash rate further, downside risks to activity were highlighted, particularly caution in terms of household spending, as well as downside risks in the labour market, noting that, in quotes, many indicators of the labour market had softened in the last year.
Number 4. Adelaide says the board elsewhere characterised the labour market as still tight and appeared alert to upside inflation risks.
There was also discussion of whether monetary policy was even restrictive now, which is something that we saw a little bit of in the September minutes and certainly in the November post-meeting statement. In quotes, on balance, members judged that financial conditions were slightly restrictive, but that it was also possible this was no longer the case.
Number 5. ANZ Roy Morgan Australian consumer confidence rose 0.7 points to 84.2 last week after 2 falls in the previous 2 weeks. ANZ economist Sophia Angala says the result was boosted by the time to buy major item index.
Consumers' confidence in their economic conditions also improved last week. The end to the US federal government shutdown could have driven that outcome, but also looking domestically, we also saw that Australia's unemployment rate decline in October, and the data print last week also could have supported that.
Sophia Angala there. Now, in our deep dive interview, ANZ Commodities strategist Soni Kumari analyses China's quest to establish a global gold trading hub.
China is both the world's largest producer and consumer of gold. It produces 10 to 11% of global output and accounts for 25% of global gold demand. So, this gives China a significant influence over global supply and demand for gold. China's central bank has been one of the leading buyer of gold, and there have been many periods of sporadic gold buying by the PBOC over the past decade, but a major shift in buying came when the US-China trade tension intensified back in 2018. Then again, starting in late 2022, there was another surge in gold buying, and that has been continuing till now. So total holdings for China's, official gold reserves is now over 2,300 tons by end of last quarter. So now, if we look at the numbers, China's gold reserves have increased from 2% of the total reserves to 7% now. While this looks significant, but it is still lower than the global average of 18% and well below what other big economies are holding. So this indicates that China still has got some room to keep accumulating gold.
So authorities there are trying to build trading infrastructure and encourage domestic and international traders in the Chinese gold market. How's that going?
Yes, China has been expanding its gold market and aiming to become one of the major gold trading hubs. So after launching the Shanghai Gold Exchange, which is a top spot exchange, and complementing it with a future exchange, that is Shanghai Future Exchange in 2008, China is now considering to expand its storage vault in places like Hong Kong, Singapore, Dubai, and Zurich. And this is a strategic move to attract foreign investors to trade in yuan denominated contract. And the SGE has opened its first offshore vault in Hong Kong this year in June, and introduced yuan-based contracts for global investor. And this is consistent with their long-standing campaign of yuan internationalization. So China is also deploying policies which are supportive for investment demand for domestic investors, and the latest changes in value-added tax will see domestic investment demand increasing for gold. And just to highlight here, unlike other exchanges that primarily trade, paper contracts, the SGE gives emphasis to fiscal delivery. So this reflects the real supply and demand in the market and can create, better benchmarking for gold prices. At the same time, liquidity is also picking up in both spot as well as future exchanges in China.
So what other global gold trading hubs is China up against? And how long before it can compete against those sorts of existing players?
Well, the path to China becoming one of the important global trading hub for gold, I think it's going to be a gradual process and needs some, real reforms. The big hurdle here is the lack of confidence among investors and countries about China's market. And the market is not as liquid as you would see in places like London and New York. So the long-term game changer could be the capital account liberalization. So if China makes it easier for investors to move funds and liquid asset in and out freely, I think this can potentially improve the international participation. And we see the ongoing effort made by Chinese regulators to will enhance the regulatory environment to attract foreign interest in China's gold market.
Soni Kumari there talking to Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, November the 19th. Catch you tomorrow with more detail on how Australian wages tracked over the third quarter. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.